Okay, so right now in the Japanese stock market, something pretty rare and powerful is going down. According to the popular analyst show, this isn't just another rally. He's calling it a bonus stage. Today, we're going to decode exactly what that means, why it's happening, and what you need to know about it.
A bonus stage. I love that term. That's really the theme for today. The idea here is that the market isn't just chugging along. It's in this special high-octane phase that's being driven by some really powerful forces. But this isn't just some gut feeling he has, right? There's some hard data behind this. And here's a big piece of it. This number, 17.84x, is the Nikkei's price-to-earnings ratio. It's just blown past its recent highs, which is a huge signal that valuations are getting stretched and that something pretty unusual is happening under the hood. So here's our game plan. First, we're going to break down what exactly this bonus stage is. Then, we'll get into the engine that's really driving it, the classic short squeeze. After that, we'll cover Show's essential rules for navigating this kind of wild environment. And finally, we'll look at what he's watching for signs that this party might be coming to an end.
Okay, let's dive right in. So what does Show actually mean when he calls this a bonus stage? Well, think of it as a period of just unusually strong and really rapid gains. Gains that go way beyond what you'd expect from the normal market fundamentals. And it's being powered by a very specific kind of fuel.
I mean, the market is just firing on all cylinders. We've seen the Nikkei jump over 700 points in a single session. And that PE ratio is in territory we haven't seen for a while. But the most important point here, the real key, is the primary fuel source. Massive short covering. This isn't about new investors piling in with optimism. Nope. It's about investors who bet against the market being forced to buy back their positions, and that is creating a powerful upward spiral. So let's take a closer look at that core mechanic. Show calls it a fumigage soba, which basically translates to a short squeeze market. You got to understand this because it's the engine behind these explosive, almost illogical seeming gains.
So what is it? A short squeeze happens when investors bet that a stock's price is going to fall. They borrow shares and sell them, hoping to buy them back way cheaper down the line. But if the price goes up instead, they start losing money fast. They're forced to buy back the shares to cut their losses, and all of that sudden buying demand just pushes the price even higher, creating this vicious feedback loop. Well, vicious for the short sellers anyway. And you can actually see this whole thing playing out right now in a stock that pretty much everyone knows, Oriental Land, the operator of Tokyo Disneyland. It's a perfect case study for the kind of data Shaw looks for.
And this table just perfectly illustrates the whole setup. The key number to look at here is the margin ratio, 0.88x. See, anytime that number is below 1.0, it means there are more shares being shorted than being bought on margin. Put simply, more people are betting against the stock than for it. For Show, that kind of imbalance is pure rocket fuel. With the price already trending up, those short sellers are getting squeezed, and their forced buying is just pushing the stock even higher. Now let's look at an even more dramatic example, the semiconductor equipment maker Lasertec. In this case, an analyst made a very public bet against the stock, and it just backfired in the most spectacular way. According to Show, it was what he called an obvious plot. An analyst firm lowered its rating on Lasertec, set a price target way down around 11,000 yen, and they were likely holding a huge short position to profit from the fall. But the market just called their bluff. The price didn't fall, it soared up towards 17,000 yen. Show's term for what happened to those short sellers? Marukoke, which means scorched or burnt to a crisp. You can just feel the pain in that description. So a market like this is obviously really exciting, but it's also incredibly dangerous. The same forces that create these massive gains can reverse violently. So in a market this wild, Schauder offers some crucial rules for investors to protect themselves, to avoid being the ones who get scorched. This is his #1 non-negotiable warning. He says he has seen countless investors get completely wiped out by using borrowed money or margin on those super speculative biotech stocks. Their outcomes are so binary, a drug trial can either succeed or fail overnight. Using leverage on that is, in his words, just a recipe for disaster. And this leads to one of Xiao's more philosophical points. He really emphasizes that true market wisdom, the ability to make good decisions consistently, it doesn't just appear out of thin air. It's built on a foundation of knowledge and, maybe most importantly, experience. You just can't jump into a complex market like this and expect to win without putting in the work.
And this follows right from that last point. In a bonus stage where everything seems to be going up, it's really easy to make a bad decision that gets bailed out by the rising market. Shio warns his viewers not to misinterpret that luck as skill. A lucky break doesn't validate a poor strategy, and that kind of confusion can be seriously costly when the market eventually turns.
So if this is a bonus stage, well, bonus stages don't last forever. For our final section, let's look at the key signals Shio is watching to know when this party might be winding down.
So, how does Shio track the market's health? First, he monitors the fuel gauge. He's watching the margin ratio on leveraged ETFs to see if that short interest is drawing up. Second, he's watching the charts for signs of exhaustion, things like the end of a strong band walk. That's a technical term for when a stock's price just rides the very top of its trading range. It's a sign of incredible momentum, but it can't last forever. The key takeaway is simple. Once that short covering fuel runs out, the market can fall, and you can fall fast.
Now, to understand just how unique this technically driven bonus stage is, it helps to look at a really fascinating contrast from the US market. On the exact same day the Nikkei was surging, the Dow Jones was also up, but its engine was something else entirely. Yep. The biggest contributor to the Dow's gains was United Healthcare, a healthcare company, and the reason for its massive jump had nothing to do with charts or broad market sentiment. It was something else. The stock leaped almost 10% in a single day. And the reason? The news broke that Warren Buffett's company, Berkshire Hathaway, had bought a position. That's it. This was a rally sparked not by a short squeeze, but by the influence of a single famous investor. The impact was just staggering. This Buffett effect on one stock was so powerful that it propped up the entire Dow Jones average. If you take that one stock out, the index would have actually been negative for the day. This just highlights the difference so perfectly. While Japan's bonus stage is driven by market mechanics, here we see how a single, human-driven story can completely change the entire picture.
And this leaves us with a final thought to chew on. Japan's bonus stage is a powerful machine, driven by data, by predictable mechanics. But as the Buffett story reminds us, there's always a human element, always a potential wild card. So as we watch the technicals for signs that this bonus stage is ending, the bigger question might be, what unpredictable human surprise could be the thing that changes the entire game?